Well, hello, everyone, and welcome. Cynthia Tomain here with Interactive Brokers, and you've joined us for today's presentation on long volatility strategies using the VSTOXX futures and options. I'm very pleased to have with us today Russell Rhodes. Russell has been a long-time webinar contributor for Interactive Brokers, and now in his role as head research and consulting with EQ Derivatives, we're very pleased to have him back with us. So please join me in welcoming Russell, and I'm going to go ahead and pass you those slides, Russell. Thanks for joining us. If you can share your desktop, let's get underway.
All right, I'm going to share my desktop, and you're going to let me know if it's working right. How's that look?
Full screen looks terrific.
Full screen. All right. We're everybody in the world is now technology experts like this. We've all had to do it. So we'll get going. Now you know what Cynthia and I have been doing for a decade. So before I get going, just my quick disclosure statement. We're not affiliated with Interactive Brokers. We're not a broker dealer. We're actually a consulting firm that focuses in on equity derivative usage, over-the-counter derivative usage, and of course, volatility derivative usage, which is a market we're going to talk about today. I am going to go through a couple of back tests that I have done and just show how consistent strategy may have worked in the past. As always, that is not a guarantee of future results, but did want to put pen to paper and show exactly how these things have worked in the past, as opposed to just throwing strategies out there. Now, I'm going to spend just a few minutes talking about VSTOXX. I think I see a lot of familiar names in the attendees. I think a lot of people are familiar with VSTOXX, but just talk about the index, the behavior of the index and the futures just a little bit. Talk about just some short-term option strategies based on maybe if you're looking at a one-day catalyst. I'm going to use data from one of the many one-day Brexit catalysts that we had, one back in early October of last year, and then talk about a consistent approach that turns out that may work pretty well, hits a bunch of really short singles over and over again, but put you in a position to benefit financially if we get another one of those big volatility events like we had back in the spring. Summarize, I'll do my best to answer questions. I've got the question box open. If I skip over your question, it's because it'll fit in a better spot, or I will cover it at the end, but Cynthia can attest to this. I'm always really good about making sure that I get to all the questions before we're done at the end of the hour. Now, VSTOXX, it's a volatility index that measures the expected 30-day volatility, the subsequent volatility for the VSTOXX 50, which is a great benchmark index to give us, continental-wide performance of stocks in Europe. The price input for VSTOXX, it uses VSTOXX 50 index options, and we take a couple of expiring series, we combine them together, and we get that consistent 30-day measure of volatility. And like any broad-based index volatility, there is an inverse relationship between the daily price changes of VSTOXX and the VSTOXX 50. And one of those old Wall Street phases is, stocks take the individual stocks take the stairs up and the elevator down. VSTOXX is kind of the other way around, takes the stairs down and takes the elevator up, and tends to move very quickly to the upside. Here's just a full history of VSTOXX, and the way that I like to show it, I don't think day over day changes or where a volatility index lands at the end of the month. It's a really good indication as to the price level or what that index has done or what it is telling us. I think you want to look at a range, see how high it got, see how low it got, and then instead of a closing price, I like to use the monthly average. And this is just those figures going back to the beginning of 1999, goodness, and just running through the monthly high, low, and average for each month up to June of 2020, last month. You can see we've got some periods of higher volatility. And then we've actually, had an awful lot of periods where things have been kind of flat. Of course, on the far right here, we have somewhat of a mirror image of what happened in 2008. I know that there are fundamental differences between these two volatility events, but price-wise, there were some similarities. And I'm not predicting the future for the broad-based indexes or volatility, but we're still working through the whole volatility process, or reverting to what we consider normal volatility for VSTOXX 50 options post the big move up to the 80-90 range that we experienced just a couple of months ago. Seems like a much longer time ago. Very typical chart of a broad-based volatility index and the price action in the underlying market. You can see that VSTOXX actually did start to creep higher as the VSTOXX 50 sold off, as the pandemic that we're still dealing with to a certain point was working itself basically through the financial markets and through everybody's concerns about the financial markets. I do want to show one little thing here. It's going to be really hard to see, but it's a pattern that we often see when you get a bottoming out of a broad-based index. And where I put the highlighter right now is actually the high for VSTOXX, but we haven't put in the low yet for the VSTOXX 50. We did put in a lower low, but we didn't put in a higher high for VSTOXX. And I always tip my hat to Larry McMillan. He's the one that picked up on this pattern with respect to volatility indexes and the corresponding broad-based index. It does tend to hold up pretty well, even on like a 1-minute chart. So I like to tell people, if you're trading futures or options on the VSTOXX 50, and you don't have VSTOXX, even just the spot VSTOXX index on your screen, you're really not participating in that market with all the information that's available to you. So at minimum, I've seen this pattern play out again in 1-minute intraday charts, where maybe the VSTOXX 50 is making new lows on the day, but you're not seeing VSTOXX make new highs, and it presents itself as some sort of a buying opportunity. So I do want to highlight that. It's a little deviation, but it's a little piece of information that I think people find somewhat useful. Now, the short-term trades that we see with volatility derivatives, they can be effective when we see a known unknown on the horizon. And that's because, unlike individual stock options, where we see the implied volatility expand in front of a known unknown, probably the best example of that is earnings season, which is just kicking off in the US. You have a difficult time maybe taking a directional trade because the options will come across as being too expensive. You'll have to look for some sort of spread trade that might work out in your favor. Broad-based index option implied volatility is not as anticipatory as individual stock option volatility. And because of that, if you've got a broad-based catalyst on the horizon, you can actually, possibly play that catalyst or protect yourself if you think that we're going to have a volatility event around that catalyst using VSTOXX options. And that's what I'm going to take a look at here. I'm going to take data from October 1st of last year, a day before we got some news on the continuing Brexit saga, and just show some different ways that you could go about playing this. Now, one thing you could have done is you could have just bought the futures contract, which is a fairly straightforward process, and I'll show how that would have worked at the end of this section. But what I'm going to do is I'm going to work my way up to a spread trade that I see pretty often in front of major economic numbers or major political situations that in the European markets. So you can actually, if you want, whenever you think there's going to be a one-day move, you can buy a call option. That's pretty straightforward. You've got better leverage with this trade relative to the two spread trades that I'm going to show. You benefit more if we do get a true volatility event, but if the market doesn't move at all, if the market drifts lower, it can be the more costly of the three option-based processes that I'm going to run through. So I mentioned October 1st. The October VSTOXX future was trading at 1685. Just a couple of alternatives here. A slightly in the money and a slightly out of the money option contract. You could have bought the October 16 call for $1.60. You could have bought the October 17 call for $1.30. And if memory serves me correct, these options had 11 days left, 11 trading days left to expiration on October 1st. And using just a basic Black-Scholes calculator and some conservative assumptions, here's how this trade would have worked out based on a one-day hold. And keep in mind that October 1st, again, was before an announcement that may have had an impact on, it did have an impact on VSTOXX 50. And this is kind of the one-day hold outcome. If you're doing this for a one-day trade, if you entered it in the afternoon on October 1st, you're going to want to exit the trade at some point on October 2nd. And you can see that I'm going to get my highlighter here. A little bit of room here between where the October future was and the break-even level. That's a one-day time decay, which is starting to kick in a little bit because there's less than 2 weeks left to expiration for the October options. So we would expect a little bit of a loss if it didn't move at all. Of course, if it moves to the downside, we would expect some losses. I also threw some assumptions that implied volatility would drop a little bit if the option implied volatility on the VSTOXX options would drop a little bit if we had a negative move to the downside. But you can see that we can benefit to the upside. Unfortunately, I have to switch back and forth to move this from my pointer to the highlighter to move from slide to slide. So, and then I just created a table showing that data as well, just to illustrate a little bit better what works better in different situations. Typically, the 16 call is going to work better to the upside. The 17 call is going to hold up a little bit better to the downside. So maybe the choice between these two is how much of a move to the upside are we expecting, and do we, how are we concerned or are we expecting? If we're concerned about a move to the upside, maybe you look at the 17 call. If you're expecting a move to the upside, maybe you take a look at the 16 call. Now, the implied volatility on these options was up in somewhere between the 80 and 120 range for all the options that I use in this presentation. And although I know that it's too simplistic to say that elevated implied volatility means they're expensive, because it's all relative to what kind of price moves you might get, they do appear expensive to a lot of traders. So one of the great things I learned when I was at the Options Institute is if you think an option's expensive relative to your outlook, maybe you sell an option to offset some of that cost. And so going back to October 1st, once again, what I did, I just arbitrarily chose to sell the call options that were 4 points out of the money. Looked at selling the October 20 call versus the October 16 call, and looked at selling the 21 call versus the 17 call. So net result there is a cost of 95 cents for the 16-20 bull call spread, cost of 75 cents for the 16-21 call spread. And here's how the payout looks for the one-day hold for both of these trades. And it gets a little bit trickier here with respect to this trade. One nice thing about this spread trade is if the UK had come out on October 2nd and said a bunch of things about Brexit and the market didn't react much at all, you actually would have a pretty good shot of getting out of this trade at break even. And as I mentioned before, we commonly see some option spread trades in front of macro catalysts. That's what we'll call them, macro catalysts here. So the break even is pretty close to where if the October VSTOXX doesn't move at all, which is highly unlikely on a day that we're going to get some market moving news, but if it happens, we're pretty much going to break even at that level. And you can see that once again, the 16-20 call spread got a little bit more downside if things don't work out. The 17-21 call spread has a little bit less upside if we do have a move to the upside. It really does come down to, are we concerned or are we expecting? If we are expecting that the market is not going to take whatever announcements that's coming out favorably, you're looking at the 16-20. If we are under the impression that it might be bad, it might be good, and you're worried about the downside, the 17-21 bull call spread makes a little bit more sense. So then finally, in this spread trade is just extremely common, the last one. And I see these, I've seen these for in front of major numbers, probably on it's very rare that we have a known unknown in the macro market where I don't see at least one short put plus bull call spread that comes in the day before. This is the closest thing to the common macro earnings trade using VSTOXX options. So what I did was I actually, I used the 15 put because I wanted to show at least one trade that took in a credit. And so I took in that, or I used the 15 put, which is down just 1 point. And then I used the 16 put on to combine with the 17-21 call spread. And that's the one where I get a credit. But I just wanted to do at least one example where we put the spread trade on and we got paid for putting the spread trade on. This second trade, the 16-21, the 16-17-21 spread that's put on for a small credit, that seems to be the more common route that people will take, where they put something on that's got no cost, small credit, or maybe a very small debit. So in this case, we would have something that looks a lot more linear as far as the payout goes, and there is more downside to this one than there is to the other two, and that is just a function of the short 15 put or the short 16 put, depending on what route you go. The downside is a little bit more dramatic in this case for the 16-17-21 spread as opposed to the 15-16-20 spread. Just a little bit different because of the short put in the bottom spread here being closer to at the money than the 15-16-21 call spread. And it's hard to see, but I promise you actually, a small move lower in VSTOXX futures would actually break even. And if it didn't move at all, you actually would make a small amount of money, probably after commissions and everything, be able to get out of this trade with no cost. And the trade, and by size, it looks like there are some consistent traders that do this trade. They're always in the same size range, consistently doing this and breaking even on the catalyst, but then having one that moves in your direction. It might be the sort of thing that somebody wants to look at as a systematic approach. In fact, I'm writing that down because I like that approach. So just taking a look at the payoff table for these two, you can see that if we just edge up to 17, you've got a small profit there. At a certain point, this one's got a little bit more, it's a little bit more dynamic than the other two spreads. To about here, you do better with the 15-16-20 spread. About here, the 16-17-21 spread starts to take over as far as profitability goes. So whatever kind of forecast you have, whether it's certain we're going to get the move, not particularly certain, just taking the various risks and rewards into account, I think makes a lot of sense with this. And so what happened with all of these trades? Well, first off, the October futures contract did move up from 1685 to 1945 on October 2nd. If you had purchased The 16 call, you'd have made a profit of about $1.95. If you'd purchased the 17 call, you'd have made a profit of about $1.70. A little bit less of a cost to make the $1.70. For the 16-21 call spread, you actually have a 100% gain there. You're not supposed to put percent gains when you're talking about one-day moves, but call spread would move from 95 cents to $1.90. The 17-20 call spread moved from 75 cents up to $1.55, a little bit more than a double. And then finally, the short October 15 put, October 16-21 call spread, that one gained $1.25. And the other spread got a -5 there to try and show that that was put on it as a credit, actually would have gained by $1.40. So just the outcome for these trades that could have been put on in front of a catalyst. Now, this is what you always want to put the really good stuff toward the end. And this is a consistent strategy that I took a look at. I tried to find some sort of trade that you could do with VSTOXX options that wouldn't be terribly costly if you consistently did it, but allowed you to be in the market where when the unknown comes along, such as the most recent volatility spike that we experienced, how could we go about doing that? And the VSTOXX futures are typically at a premium relative to the underlying index, which when you're trying to play some sort of catalyst move, the futures are not going to move up as much as spot VSTOXX. That's just a characteristic of volatility derivatives. However, this can work in our favor if we put on a certain type of trade, because as expiration approaches, futures prices do gravitate toward the underlying index. The pending expiration doesn't really have any impact on the underlying VSTOXX index, but it does cause the futures to gravitate toward the underlying spot. And that's going to be something that we take into account with this trade as well, or this trade, basically, I'm going to say trading system. So there are instances where VSTOXX futures rise quickly, and there are lots of instances where the VSTOXX future will drift down to spot VSTOXX. So here's what I did, and I tried to be very rules-oriented, because if you put subjectivity into this and you start twisting things around like that, it kind of opens you up for criticism. But this is a very straightforward, rules-based concept. And there's actually an explanation of this on Eurex's website right now, on their blog site. So if you want to see that, I'm happy to dig out the link and share it with anybody that wants to shoot me an email. So the day before the current month settlement. So if today were the day before July settlement, we'd be looking at the August option. And only execute this trade when the spot VSTOXX is greater than, or execute this trade only when the next month VSTOXX future is at a premium to spot VSTOXX, because we're going to want that drift to come into play if we don't get a volatility event. So, and basically we're looking at doing a 1-by-2 spread where we sell an at the money or slightly out of the money call option based on where the strike price is relative to the corresponding VSTOXX future, and then going out of the money that where we use an out of the money, we sell 2 out of the money calls that are 2 strikes that are the second strike that results in the trade being done at a credit, and then hold that trade through settlement. I know there's a lot of moving parts there, so we're going to give you an example of this. So here we've got where spot VSTOXX was and July VSTOXX was back on the day before June VSTOXX settlement or expiration. And what we're concerned with is this is the underlying price, that 1440. And with 1440 as the underlying, we're going to look at starting out the spread. We figure out the spread by selling the July 15 call for 90 cents. And then we start to go up strike by strike. So if we So we're selling the July 15 call and taking in 90 cents. If we buy 2 of the July 16 calls, that costs $1.20. If we buy, which would result in the spread being put on at a cost of 30 cents. If we sell 2 of the July 17 calls, that's 90 cents. That's break even. Selling 2 of the July 18 calls, that would, selling 1 of this call and buying 2 of this call would result in a credit of 20 cents. So this is the first strike where you could put this trade on at a credit. This is the second one where you put this trade on at a credit. So on June 18th, 2019, following the rules that showed up on the slide before, you would actually sell 1 of the July 15 calls, buy 2 of the July 19 calls, and the trade could be put on for a credit of 30 cents. And there's the trade. Sell 1 VSTOXX July 15 call, buy 2 VSTOXX July 19 calls, and the net result is, again, that credit of 30 cents. And this is what the payout would look like at expiration. And to backtest this, I assumed that we would hold the trade through expiration, which admittedly might not be the easiest thing in the world to do, especially when you're looking at a very large profit. But trade management is maybe something that if you take this and run with it, do a little bit more work on it, something that you could utilize. So on the trade date, the July VSTOXX future was at 1440. We actually had a summertime lull, so we had a drift lower, and the July VSTOXX settlement was down to 1174. Both options expired with no value, and the net result of this trade was a gain of 30 cents. And more often than not, that's the result of doing this sort of a trade. When we talk about the drift that we're taking advantage of a little bit, when it was the day before the June expiration, July VSTOXX was at a premium of, I don't know, a little over a point. And as expiration approached, the July VSTOXX future starts to gravitate down towards spot VSTOXX, the spot index. And then the day before these two expire, if you're consistently following the strategy, you take a look at what's going on with the August markets. So I went back to the beginning, or to the first contract expiring in January of 2018, and I looked up the option prices and took a look at how this would have worked over that period of time through the volatility event that we had back in March. I have not updated this for April, May, or June quite yet. That's actually on my list of things to do. So each of these trades, you can see that starting out with January of 2018, we've got the trade P&L of 25 cents. We actually had a 81-cent gain on the one in February, and that actually occurred because we had a volatility event. We actually settled at a point to the upside where the trade actually made a little bit of money. Also notice just about every one of these trades had some sort of drawdown over the life of the trade, which I found interesting. In December of 2018, we actually never had an instance where spot VSTOXX was at a discount to the December future. So there was never an instance where we could have actually put this trade on. Going through through March of 2020, you can see we had several more instances of very low VSTOXX where things just kind of drifted lower and we made a small profit. And then finally, March of 2020, and with a very high settlement of 89.44. I know that would have been very, if you started to see the March future move up and you've got a 20, 30, 40, 50 point gain on this trade, holding through settlement may have been very particularly difficult. But yeah, just interesting outcome for that one. And a method that allows you to be in the market, have some long volatility exposure, but not necessarily experience what most people experience when they have some sort of consistent long volatility position, which is getting hurt by that drift lower for the VSTOXX future relative to the spot VSTOXX. I think I have a summary of there we go. So we had, over that time period, there would have been 27 expirations, but again, we didn't have anything in December of, I think it was 2018. We had positive outcome 21 times. The biggest loss was 267. The average drawdown for the trade was a loss of 72. And the maximum drawdown intra-trade was actually a loss of 3 points. So, something that at some point you're probably going to look up at and feel like it's under a little bit of pressure. But again, I think a pretty good systematic approach to gather, to get the kind of exposure that I've been talking about. So I'm going to flip over to here because I'm open for all kinds of questions. I know a lot of people watch this as a recording. If you watch it with a recording and you have some trading ideas, and I already see one trading idea, I already have one trading idea that somebody's thrown at me. Do not hesitate to use that email address. Sometimes 1 or 2 full webcasts can come out of the questions that I get, and I find that extremely helpful when I'm searching around for ideas. Constantine was asking, have I back-tested the strategy in the 2008-2009 markets? We didn't have the VSTOXX markets available at that time to do that. So I haven't been able to test that with respect to VSTOXX. I wish I could. I am planning on maybe going a little bit farther back in the VSTOXX history to put a little bit more pen to paper on this one. And I got a nice note here from my buddy Mark Shore, who knows as much about VSTOXX as anybody else. He's saying, for the consistent strategy, next month futures should be at a premium to SPY. Absolutely. So we should be in contango when we put this trade on. I'm working my way backwards a little bit. How does this strategy compare with a risk reversal trade? Selling a put 2 to 3 points below the VSTOXX index and buying a call 4 to 5 points above the VSTOXX future. Matthias, that's my next piece. Thank you very much. I'm going to print that out right now. The answer to your question is, I don't know, but I'm going to go find out. I've got all the data. It's easy for me to do that. And I'll be putting something up in the next week or so on the EQ Derivatives website. And that is what I am going to specifically take a look at. How's that? I was reminded, just because I have a US-centric focus all the time, but the VSTOXX derivatives are, denominated in euros. I always think of things in terms of points, and probably I'm a little too academic at times, but do keep that in mind, that these are denominated in euros. And you can trade them on the IB platform. I have traded them on the IB platform in the past. The liquidity for VSTOXX options relative to the options that trade at CBOE, the fixed options, VSTOXX options have fairly good liquidity. It's tailed off just a little bit, but it's done that across in the past couple of months. That's a typical function of a post-volatility spike market. But when I pulled the data and I pulled the bid asks for all the options that I used to backtest these, it was typically a nickel wide spread. So you can actually get some things, you can get things done in the VSTOXX market. They've also got a handful of liquidity providers that are always willing to step up with that market as well. So I think there's decent, I've never had a problem executing trades in VSTOXX options myself. So Cynthia, I know you're close by, you're always close by.
Right here, Russell.
did anything pop up in it? Sometimes you see things in the chat box that I don't see. And then I also stall around a little bit and hope that other people ask questions.
Well, in case there are any questions out there, do want to let you know there's a questions panel. If you missed that at the beginning of our session, simply double-click that title bar and you can send any of your questions or comments to Russell at this point. Well, this has been terrific information, Russell, and I do want to remind everyone we have been recording today's event. So if you do want to come back and review what Russell has been discussing, simply watch your email later on today. We'll be sending you a direct link to today's recorded playback, as well as give you access to the same slides that Russell has been using for today's event. So let me see. One more question did come in. I saw that just happen.
I did see that, and that's a good question. What I did was I held the strategy through expiration, which was a midday calculation. And honestly, the reason that I did it that way was to stick with it being very rules-based. I do think if you get some sort of volatility event and it looks like you have an opportunity to maybe trade out or trade around the spread, there's nothing wrong with that. And when I present things like this, what I'm really doing is I'm not saying go out and consistently trade what I just showed you. What I'm really trying to do is give you the basis to maybe go out and do a little bit of extra work on your own and figure out, maybe a deviation of what I've just shown you. So, if you've got like a target price where you're going to get out if the spread hits 3 points or something like that, there's nothing wrong with doing that as well. I don't tell people how to trade, and I respect that everybody trades in their own methodology. So, you bet. I got a many thanks. So, and now, right, I did. Okay. So, and I'm just telling you right now, Matthias, keep an eye out for this risk reversal. I got the data and I'm going to work on it this evening. You're going to keep me up all night. It'll be on the EQ Derivatives site. And when I write out strategies on behalf of or using any types of derivatives like this, we actually do not put them behind the paywall, so everybody can see them anybody can see them. You don't have to be an EQ Derivatives subscriber to see any of the strategy-based pieces that I put out there. Now I'm just giving everybody 15 seconds to type a question, and then Cynthia and I are going to go on our day.
Well, Russell, I have to thank you very much. Very interesting information here today. And just do be aware you'll get a follow-up email later on this afternoon with all of this information that you can come back and review at your convenience. By the way, also watch your calendars. Russell will be back next month to talk to us about the NASDAQ futures as well. So it looks like we are going to conclude our session here today. Once again, always terrific to work with you, Russell. And I want to thank everyone for your participation in our webinar here today. You can all exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and we look forward to seeing you next time for more information on volatilities. So Russell and EQ Derivatives, I want to thank you for making today's event possible. You can all exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone.